yeah, we'll try this out, see how this goes. Spotlight video will be recorded. Okay, cool. Thanks, Teams. Okay, so yeah, we'll record this. I will see what I can do about getting a drive. If I can fit this onto a Microsoft SharePoint, then that's probably what will happen, because obviously Foskey has that set up. Otherwise, we'll see. This is obviously going to be a very large file, as you would imagine, given that we're talking about a 3-hour class, even if we stop recording during breaks. So it may be that if stuff gets uploaded, it will have to be very quickly deleted. But yeah, we'll see what we can do with this recording. This is not often people want to video record me. I'm not that pleasant to look at normally. Slide 6 of our handouts. We're talking now about the types of partnerships. So of these 4 types of partnerships, there's really 2 that are highly relevant for purposes that you're going to encounter in the real world or actually care about very much generally. So the first is a limited partnership, which we're going to talk about on the next slide. But the other one is a Canadian partnership, and this is defined in subsection 102.1, and it's a partnership where all of the members of the partnership are Canadian. And so this is important. This is important classification for the purpose of tax deferred transfers, because all the transfers we just talked about, like subsection 97.2, subsection 98.3, subsection 98.5, those all require that the partnership be a Canadian partnership. And the reason for that is that if we didn't limit it to Canadian partnerships, because partnerships are very flexible in their ability to allocate income and don't have entity level tax, generally speaking, if we allowed tax deferred transfers to a partnership that was not a Canadian partnership, you would be able to do something like, for example, take a asset with an accrued gain on it, and you could transfer that to the partnership on a rollover basis under subsection 97.2, dispose of it, realize an accrued gain on that disposition, allocate the accrued gain to a non-resident person who, if the gain isn't on taxable Canadian property, just wouldn't have to pay any tax in Canada. So you could effectively undercut the entire Canadian tax base as long as you knew a non-resident to do a transaction with every time you wanted to sell something. Obviously, subsection 103.1 and 103.1.1 would have something to say about that, but a very real concern. So that's why why Canadian partnerships are important. Professional partnerships, that's not a defined term, but when you read the relevant sections of the Act together, most notably section 34 and subsection 96.1, it's a partnership that carries on certain types of professional practice, and they can compute their income kind of without reference to work in progress, although amendments to section 34 over the last couple of years have basically taken that ability away. So the partnership, professional partnership classification is becoming increasingly irrelevant. You might care a little bit about what it means to have a professional partnership, again, if your legal careers are smashing successes and you become partners in the law firm. But unless and until then, you probably shouldn't care. And then the last classification we have on the slide is a SIFT partnership, which is basically it's a flow-through partnership that it would be publicly traded. And so there's a definition in subsection 197.1. It basically talks about a partnership that is publicly traded that owns one or more non-portfolio properties as defined in subsection 122.1 sub 1. Basically, the idea here was to capture publicly traded partnerships that were being used as a substitute for public corporations. And this was a very 2006 concern that came up with income trusts. I think many of you were probably in late elementary school, early high school in 2006, which is a reminder of how time marches on. But the idea of what was happening was that many Canadian public corporations were converting to income trusts or to partnerships that were publicly traded. And the rationale for doing that is that the Canadian equity market is very heavily skewed towards non-taxable entities. So, for example, pension funds, sovereign funds, other tax-exempt type entities, plus non-residents who are generally not subject to tax on publicly traded securities in Canada, make up such a significant component of the Canadian equity market that it made sense for what were once publicly traded corporations to convert to income trusts or publicly traded partnerships so that all of their income would flow through. They wouldn't have they wouldn't have entity level tax. Any entity level tax would have been paid by the investors who were tax indifferent, and the earnings per share would go up as a result of not having to pay any Canadian corporate tax. And so this looked like, this was doing some serious damage to the Canadian corporate tax base. And then when on the same day, Bell and TELUS proposed that they were both going to convert to income trusts, the Harper government at that time, shit a brick, to use the vernacular, and introduced rules to clamp down on that, which were the SIFT rules. So nobody has SIFT partnerships anymore or SIFT trusts. They all converted back to corporations because we proposed to impose entity level tax on the partnership or the trust. So that was the end of SIFT. So a fun walk in the past, and you don't need to care about that anymore. Moving on to slide 7. This is where you do need to care. And this is our second type of important partnership, and it's the limited partnership. So limited partnerships are creatures of statute. And the requirement under every relevant partnership act is that you have to have at least one partner with unlimited liability, and then your other partners are limited partners, and they're liable only to the extent of their investment in the partnership. These are going to come into play in situations where the partners want the protection of limited liability as though they had incorporated. So pretty much anywhere where you have sophisticated clients who want to have a partnership, they're probably going to want to have a limited partnership in order to, kind of have the best of both worlds. As what I've said in the slide is there's a couple of instances where limited partnerships are especially prevalent. And if you think back to Ian and Pam's comments, these two places really shouldn't surprise you. The first is real estate development. And the reason for this is that land inventory can be transferred to a partnership on a tax-deferred basis under subsection 97.2, but it cannot be transferred on a tax-deferred basis to a corporation under subsection 85.1, which we'll talk about a little bit later on in the course. So this is a pretty significant advantage for real estate developers when they want to combine their businesses or combine parcels of land into a single undertaking. Using a partnership rather than corporation as your vehicle to carry on business is a way that you can defer the tax on your combined accumulation of land inventory until it's time to sell it. The second place is any undertaking that involves a tax-exempt person, either as a 99% limited partner or as some lesser partner in the undertaking. These tax-exempt entities can include pension funds or Indian bands are the two big ones that you're going to see in Alberta. These undertakings need to be carried on through a flow-through entity because otherwise the benefit of their tax exemption would be lost if you had a corporation and you were subject to entity-level tax in the corporation. Generally speaking, limited partnerships and general partnerships are subject to the same tax rules, but there are two very important exceptions. The first is that limited partnerships are subject to what we call the at-risk rules in subsections 96.2.1 through 2.7. And what these rules do is they restrict the flow-through of losses from the partnership to the partners to the extent of the cumulative, the partner's ACB in their partnership interest, plus the cumulative net income that has been allocated to the partner by the partnership. So in determining the at-risk amount that's available to the partner, the ACB of the interest gets reduced by the amount of any loans to the partner from the partnership or any non-recourse debt incurred by the partner to acquire the partnership interest. And so the point here is to only allow the flow through of losses through a limited partnership to the extent of the limited partner's actual economic investment in the partnership. And for these purposes, we assume that, number one, a loan from the partnership is never going to be repaid. And similarly, we assume that a limited recourse debt is never going to be repaid and therefore does not resemble an economic investment. And certainly, if you look at all the partnership-based tax shelters that proliferated in the 1980s, that was those are both pretty sound assumptions. The second major difference between limited partnerships and general partnerships is in subsections 43.1 and 3.11. And what these provide is that to the extent that a partner has, so backing up before we get there, if we go to, and we're going to talk about partnership interest basis in a little bit, but what paragraph 53(2)(c) provides for is a negative adjustment to partnership ACB when the partnership distributes cash or when the partnership allocates losses to a partner. And that, generally speaking, for income tax purposes, you're not allowed to have an ACB below 0. In a general partnership, you are. That's the one item of property that is allowed to have a negative ACB for income tax purposes is the general partner's interest in a partnership. Limited partners don't benefit from that exception. So what will happen is that if a limited partner's ACB goes negative, subsections 43.1 and 3.11 are going to deem that limited partner to have a capital gain equal to the negative ACB, and then the ACB just resets to 0. So those are the pretty critical differences there. If we move on to slide 8, we have two questions. First, about when a partnership exists for the purpose of the Act, and the second were about factors that distinguish a partnership from a joint venture or joint tenancy. And I think we cover a little bit of this stuff in the handout. So did anybody want to jump in on question number 1? Okay, seeing no one. The answer to question number 1 basically is that a partnership exists for the purposes of the Income Tax Act if it would exist for commercial law purposes. So there's a trilogy of Supreme Court of Canada cases called Continental Bank, Bachman, and Spire Freezers. And what those cases suggest is that the existence of a partnership requires nothing more than what the Partnership Act says basically in the preamble, which is that it requires 2 or more persons carrying on business in common with a view to a profit. So there's really 3 elements, right? There's the carrying on business, number 1, in common, number 2, with a view to a profit, number 3. For these purposes, the court said, well, a business has a very broad meaning. It includes things that would not normally be a business. For example, just the passive ownership of a rental building is a business for this purpose, even though it would not necessarily be a business for income tax purposes. The requirement that you have a view to profit or a motivation to earn a profit, what the courts have said is, look, that can be ancillary to some other primary purpose, but it still has to exist. So, for example, your primary purpose for creating a partnership can be tax avoidance, which that happens in real life on a frequent enough basis. But as long as you have some ancillary intention to earn a profit or desire to earn a profit for the partnership, then that's good enough for the partnership to exist as well. And then the final requirement is that the business be carried on in common. And this is the least well-defined of these terms, and it hasn't as much been an issue before the courts as the other 2 requirements have been. It certainly looks like the Supreme Court has said it's going to take we know it when we see it approach to whether a business is carried on in common. But generally speaking, if you have a sharing of the income or loss from the business in some kind of proportion between the partnerships, then you probably have the business being carried on in common. And so that's fine. So, as long as there's some provision for sharing in the partnership agreement, not, one partner gets 100% and the other partner can never see any upside, you're probably fine there. So the CRA has obviously, like many things, chimed in on this as well. And they've said that they have a number of things they look for in determining if a partnership exists. So they look for things like joint contributions by all of the partners, joint interests in the property of the partnership. Again, not that everybody has to have an undivided joint interest in every piece of property, but that there's some kind of understanding that there is a joint interest in the subject matter of the partnership. Profit sharing, mutual control, and whether the partners have held themselves out as partners in filing the returns or otherwise. And the last part is important because, again, if you recall from corporate law, if you hold yourself out as being a partner and you hold out that there is a partnership in existence, that generally speaking, that kind of creates a presumption that a partnership does exist unless there's, significant evidence otherwise, and people are entitled to rely on that representation. So the CRA is not going anywhere crazy on that point. They have actually, there are a lot of ongoing audits right now where CRA is challenging the existence of partnerships at all. So this is, you're close enough to being in practice, especially those of you in third year, that if you do practice tax and do any kind of dispute or litigation work, you are going to see questions about valid existence of a partnership. So a useful thing to familiarize yourself with in real life. The second question is, asking you to distinguish between a partnership and a joint venture or joint tenancy. Ian's got a question.
Oh, I could, I guess, speak to the second question if.
Yeah. Oh, absolutely. Please do.
Oh, okay. I guess with JVs, they're kind of like temporary, almost like they would dissolve once the project is done and over, and also JVs. They have more freedom to contract. They're more creatures of contract rather than statute. So you have more freedom to I guess put whatever terms you want in the JV.
Yeah, and I think that's absolutely true on both points. The JV does have, like I said, considerable contractual flexibility, and as well, absolutely, the JV can exist for. And generally should exist for a limited purpose as opposed to the partnership existing over the whole term. Beyond that, beyond those 2 points that Ian has raised, the CRA has a few others that you can think about as well. The first is that there has to be joint rights in the property that's the subject matter of the joint venture. There has to be a mutual right of control by the participants over the property of the joint venture and the enterprise, and there has to be a limited objective. So that goes to Ian's point about how the JV should theoretically only exist for a single purpose and then dissolve. What the CRA does not note, which is important, is that joint venturers cannot hold themselves out as partners, and they should generally indicate that they are, undertaking a joint venture and not members of a partnership. And that is especially important, how you communicate that you have a joint venture and not a partnership, and especially communicate that you do not have a partnership, because the difference between joint ventures and joint ventures and partnerships are sometimes not that meaningful, right? When the CRA says that both a joint venture and the partnership, well, you have to have some kind of mutual control, and you have to have some kind of joint interest in the partnership, or joint interest in the property rather. You're sort of saying to yourself, well, that sounds like the exact same thing. You're just repeating twice, which is a fair criticism, right? So it can be a very fine distinction in real life. So how you hold yourself out to the public and to the CRA are very important points, right? It's not determinative because obviously people say self-serving stuff all the time, but it's important that you be consistent on those points. So if you're trying to either have a partnership or not have a partnership, it's useful to compare. So in comparison, a partnership should have partnership property that's registered in the name of either the general partner or the partnership itself, depending on what your jurisdiction that your property is situated in will allow you to do. This contrasts with a joint venture, where generally speaking there is no combined property of a joint venture. People might allow their property to be used in the joint venture, or the joint venturers might acquire property that they're going to use, to carry on the joint venture. But there's no, whole of the joint venture property. Every asset, every joint venture has an undivided interest in that property, and they could alienate it at any time, generally, again, subject to what's in the contractual joint venture agreement, so, without the consent of the other joint venturer. So that's very different than a partnership, where if you're a 5% partner and the partnership owns a car, you can't go sell 5% of the car. I mean, nobody would actually buy 5% of a car, but you couldn't do it even if somebody would. Next, a partnership can have a managing partner who's allowed to bind the partners with respect to the business if decisions are delegated to that managing partner. And as well, the Partnership Act generally provides that any partner is an agent of all the other partners in respect of the business. So unless your partnership provides otherwise, any partner can bind all of the rest of the partners to an agreement that relates to the partnership business. That's really not possible with a JV. Some JV agreements do provide that there's going to be a manager appointed. The manager can make some decisions, but by and large, the manager can't spend the joint venture's money, et cetera, because that's just not property over which that manager has any control. The partnership can also continue more or less indefinitely. Again, as long as you have more than one partner at all times, the partnership can continue on as it wants. And for as long as it wants. In theory, if you register a limited partnership, you can specify the date on which the partnership will come to an end. Most people just specify that the partnership will continue indefinitely, or they pick a length of time that is so unreasonably long, the partnership will just not actually continue for that long. So, in terms of other material differences from a tax point, an important point is that a joint venture has to account for their share of the revenues and the expenses of the joint venture separately. And so what happens with the revenue and expenses in terms of getting to net income is determined at the joint venturer level, and there's no entity level no entity level computation, even if there might be for accounting purposes. In contrast, partnerships, like we talked about, compute income at the partnership level. So there is a net income computation, and then they allocate that net income from sources and places. So that's a fundamentally different thing. And again, just to hammer the point home, because there's no concept of joint venture property or joint interests in the property, there's no concept of a transfer of property to a joint venture on a tax deferred basis. So what that means, is that if you want to start a JV and with somebody else, like for example, in the real estate space, where one venture is going to contribute land and the other venture is going to contribute expertise, if the person contributing the land wants to give the other member of the joint venture an interest in the land, that's going to create a taxable disposition of whatever interest in the land is being assigned to the other joint venture participant who's provided the expertise. So you have to work around that. Whereas with a partnership, you don't. You would just contribute the land to the partnership in exchange for a percentage interest in the partnership, and the other partner would pledge as a partner to devote their time and attention to the business of the partnership as consideration for their percentage interest in the partnership. So we got something going on in chat. Let's see what's going on. Possible to slow down a bit. Yes, it is possible for me to slow down a bit, and I will do my best to keep that at a reasonable speed. Hard to with online learning, a little bit hard to manage that, but I will do my best. So what I think we're going to do, because we're kind of moving now into the depths of handout 2, let's stop here and take a 2-minute break, a 10-minute break rather, since I'm sure everyone probably wants to get up and stretch a little bit and refresh their water, etc. So let's do that. I have 1:57 p.m. So if we come back at 2:07 and we'll pick it up there.